Hello and welcome to episode 358 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, we're back on a Sunday as usual. We missed a week, didn't we?
We did miss a week, and as you know, if you follow us on social media, for the most unusual set of circumstances, a podcast that was stopped, disrupted by a weather event.
Yes.
So it was actually more to do with Andy. So Storm Eunice came through, which was apparently the strongest storm in England for decades. And unfortunately, Andy, you kind of got stuck in a way, didn't you?
Yeah, I knew it was going to happen because earlier in the day we had a team catch up and I said, well, I should be fine. I'm in a new build and new builds are built, to a good standard. And I just thought there's no chance I'm going to get caught up in this. And of course, I was the first one to get hit with a power cut and I was actually out for 14 hours in the end. So we went to bed in the darkness. But I mean, lots of people got worse damage. So I'm not saying that you should feel sorry for me. It just causes a problem with the podcast.
No, but they don't do podcasts. So the problem was ours impacted thousands, Andy. So yeah, Andy even went out in that storm searching for electricity, for signal, I don't know, but it did mean that we couldn't do the show because Andy couldn't record it and therefore edit it. So we did have a break for 1 week, but it has inspired one piece on the podcast this week, which is in relation to insurance. So I might as well just kick off and say what's going to be on the pod this week. So I'm going to do a piece regarding stock markets and what's been going on in the last week. And in fact, the reaction to wars. Now, if you've been looking at the stock market this week, it has been crazy because of events in Ukraine. And so I want to talk about that because you would have been looking at your portfolio wondering, why is the market reacting in the way it has done? I'm going to try and shed some light on that for you. We're also going to do a piece on the show about sick pay. So Harvey's going to come onto the show. As a result of the living with COVID announcement, statutory sick pay has changed once again. So it's no longer going to be as generous with regard to COVID if you had to isolate. But we're going to do a piece on statutory sick pay because there are ways in which you can still be covered for things like COVID and ways to boost any sick pay that you receive if you are unwell. And also, if you are employed by a small company, but more importantly, you run a small company, then you really want to listen to this part of the show because there's something you can do regarding sick pay that will be of benefit to you in particular as a director of that company, but also your employees. So Harvey's going to be on the show for that. And finally, what's the piece you're doing, Andy?
I'm going to be doing a very quick piece on home and contents insurance. And it's just a few minutes on that piece. And it's a good FYI. It's a summary of home insurance, what you can and can't claim for.
Yeah. So I'm going to kick straight off with the investment piece. And this week, obviously, we've had the invasion of Ukraine by Russia. And naturally, I thought about doing a piece about stock markets and how they react to events like this, so wars or geopolitical events. And then as I started to research the piece and pull it together, I thought this seems quite familiar to me. And actually, I worked out that I'd done it previously. And if you go back to episode 253 of this podcast, it's well worth doing because we always do evergreen pieces. I did a show on the stock market reaction to geopolitical events. So something like what's happened this week. And if you go back then, it was in early 2020 and it was when there were geopolitical problems in Iran. And I talked about in that show how the market typically reacts. And to give you the highlight, on average, stock markets, and we're talking about the S&P 500 here in America as the sort of proxy for global stock market. On average, there is a drawdown of 5% across these events. And the drawdown means from the recent highs to the low of the market before it then rebounds. Because obviously what typically happens when you get a geopolitical event, then you will get a reaction that's negative by stock markets. And at some point that will bottom out. And on average, it takes 22 calendar days for the market to bottom after the event occurs, and then a total of 47 on average for the market to recover after that event. So go back to where it was before. And now go back and listen to that show. Pause this because there's a lot of insight in that show. And I explain how those numbers were calculated. It was based on a piece of research looking at a whole host of geopolitical events in history, including things like the Pearl Harbor attack, the Iraqi invasion of Kuwait, and even the US terrorist attacks, so the 9/11 event. And it looks at all of those and then it pulls together that research to give some decent insights. So jumping back to this week, I've obviously done the midweek market show. If you've listened to that, then you will have found out about a lot what happened in the market initially in reaction to that invasion of Ukraine. But the behavior of markets in the hours after that was almost mind-boggling when you looked at it. So when you listen to midweek markets, the market was in a grip of a really aggressive sell-off, and that is typical when you get an event such as this. It will fall aggressively, and if you look at the market, the FTSE was down around 3%, the FTSE 100 that is, and European stock markets were down even more. We got to the point where I think the German DAX was down around about 4%, and the futures, so before the US stock market opens, you can look at the futures of any stock market, but in this case, the futures for the stock market at the time I made that show were pointing to lows of 3% and even 4% on the tech-heavy NASDAQ 100. Well, if you looked at the market at the close of play in America, so yes, equity markets in Europe were down 3% typically on the day, but when we had the close of play in America, when America's market closes in UK time at 9 o'clock in the evening, you would have been shocked to see that, broadly speaking, the market had rebounded aggressively from those lows in the futures market. And we even had the case where the NASDAQ 100 was up 3%, which is absolutely mind-boggling on the day where we've had this huge geopolitical event, something that could spiral out of control, and the stock market actually rallied 3% in America. So why does that happen? What's been going on? Because you'll be looking at your portfolio thinking one thing and then seeing something completely different. And today, as I make this show on Friday, we're seeing a follow through on European markets, and we're seeing, I think as I make the show now, the FTSE 100 is up about 3%. So it's following on from America. Now, before I try to give some kind of explanation for those movements, going back to that piece of research I mentioned earlier, if you focus just on the events that were invasions, so something that was perhaps as dramatic as what we'd seen this week, such as the Iraqi invasion of Kuwait in 1990, then the drawdown we saw in the market was 16.9%, and the bottom of the market was not achieved for 71 calendar days, and it was 189 calendar days, so basically almost 6 months before the market fully recovered. And another invasion was the invasion by North Korea of South Korea in the 1950s, and the market, this is the S&P 500, fell 12.9%, and it took 23 days, and it's again calendar days, for the market to bottom, and then 82 days for it to recover. So when you looked at those incidents, those geopolitical events where one country invaded another, then they were typically the worst drawdowns of those events that were analysed by the company who carried out the research, and that company was called LPL Research, to give them some credit. Now, what does that mean for what's going on in markets now? Why didn't we see something very similar, or are we going to? Now, I don't have a crystal ball, and actually there's another event which isn't covered on the piece of research that I've spoke about in the podcast episode 253, but there was another piece of research I saw that looked at other events as well, which was actually carried out by Tilney, and they looked at a whole host of geopolitical events in a slightly different way. They looked at where the S&P 500 was 1 week, 1 month, and 6 months after the event took place, and they included some different events and some geopolitical ones and some just big market moving events. And there was one that they picked out in there that perhaps would feel like it had a comparison to what's going on now, and that was when Russia invaded Georgia in 2008. And after that happened, the market was down 1.7% a week later, but down 32.9% 6 months later. Now, the one thing I want to point out is this is one issue when looking at how markets behave on individual events, because if you look at that date, that's 2008, that was pretty much the financial crisis going on. So it is that thing that correlation and causation aren't the same thing. So just because that happened at the same time, it wasn't a result of Russia invading Georgia that the S&P 500 completely fell. So looking at this week now, the message from episode 253, because we're looking at averages, is something to take on board, that how markets typically react. And it's not as strong as some people would lead you to believe. And normally it's quite short and sharp, the market reaction, before things recover. Now, as I pointed out, it may be different this time because of the scale of what's happened with an invasion. But what occurred this week? Why has the market reacted in such an unusual way where it's rallied so much so? I mean, we're talking about the intra low that we had on the Nasdaq 100 from being down 4% pre-market to up over 3% by the close of play. They're the sort of events and movements we've seen once or twice in recent history. And you have to go back a long way to find some of those movements. And some of the similar movements we've had in markets like that occurred around the dot-com bubble bursting. So that isn't a good sign anyway. So what drove this kind of rather unusual turnaround? I think the first thing that happened is potentially that the sanctions that were announced by various Western governments perhaps weren't as serious as they could have been in terms of the impact on the global economy. So they could have gone further. So there was a slight bit of relief from equity investors in that regard. And the other thing that happened is that we perhaps saw the short squeeze. So we've talked about short squeezes before on assets, and that can be where people are shorting, so they're actually betting against a market aggressively. But then when the market begins to turn and it might start to rally, to unwind those bets, they have to buy basically the asset that they were betting against to unwind them. I won't go into the details, but of course that can be a self-fulfilling rally then as people start to unwind those bets. They end up buying the asset and it suddenly can cause a real whipsaw effect and the market rally very strongly. So that is a possibility of what we saw as well. Now, why would that happen at this point in time? And one of the reasons could be, I don't have the answers, is it could be that we've seen a market ahead of this Ukraine situation that has largely been crumbling beneath the surface. If you listen to the midweek markets episodes that I do, I talk about things like breadth, which is talking about beneath the surface of indices like the S&P 500, how individual company share prices are behaving. So if you think about it, the S&P 500, there are 500 companies in that list, how they are performing individually beneath the surface. And as a group, they could be going up, the index could be going up, but things could be falling apart and lots of them crashing. But you won't see that because when you take them as a whole, and it is obviously a cap-weighted index, so certain stocks have more influence over the index than others. And if they're the ones that are going up, which had been the tech stocks, you can hide a lot of what's actually crumbling away underneath. So what we've had is the market has been weakening for some time since the back end of last year, 2021, and certainly for some tech stocks since probably February 2021. And what's happened is the market has started to unwind to a certain degree, and we've had the situation in Ukraine, which accelerated a lot of the moves we've seen. So the idea that inflation might pick up even more because what's been going on in Ukraine and the impact on energy markets, and in particular the price of oil, is pushing up those fears about inflation and the worries that central banks will have to raise interest rates even faster to cope with that. It kind of accelerated everything. And so we saw this sell-off in tech stocks continue. And it gets a point when the VIX, which is the fear index in US markets, that's what people call it, but it basically measures future volatility in the S&P 500. That's essentially what it does. But think of it as the fear gauge. When that goes up, that means lots of people are worried. And when that's happening, at the same time where you get a very, very strong, what they call gap down, which is where a market opens very negatively from the day before, you can get something where weak hands, they would call them. So people who were on the point of capitulating suddenly all capitulate at once. And then when those people capitulate, where you get the extreme fear occur and the market really tumbles aggressively on a day, and we saw that this week, then that could almost be that all the weak hands have been flushed out of the market, and those that are going to hold and those who will start buying back in again then start doing so. And the buyers therefore outnumber the sellers and the market starts to rebound. Now, that could suggest, if that is what happened, we don't know that is what occurred, that could suggest that the market is due a rebound. Whether that rebound turns into more than just a bear market rally, which ultimately the market keeps collapsing afterwards, or something that we're going to start to rebound towards all-time highs again on the S&P 500, we just don't know at the moment. But the price action that you saw is reminiscent of what we sometimes see at least short-term market bottom. So that could have been what happened, and that then, of course, fueled that short squeeze, which caused therefore hedge funds to start having to unwind their bets on mass, which then drove the market higher. But equally, if you looked at commodities, so gold burst 3 to 4% higher on the day, which is a huge move. Then by the end of the close of play yesterday, so that's the day of the invasion happening, gold was actually down on the day. That is very unusual to see such an aggressive move up and down, and we saw it in other commodities as well, including the price of oil. Now, such aggressive moves in markets, so in those instances they were markets that were rallying, so they rallied hard but then sold off aggressively to finish at their low point of the day. That can also be a sign that markets are going to reverse, but the uptrends are going to reverse and start falling. So could commodity prices start to turn? Who knows? It's been very much the consensus trade that people are betting on commodity prices going higher because of the narrative of the situation that's going on in Ukraine. But like I say, we saw in equity markets the turnaround. So we had the lows and the markets finished at the highs. Other havens, we saw bonds being aggressively bought early on after that invasion, but then we saw them sell off again. And we're now today looking at the 10-year US Treasury yield being above 2%. So you'd almost think that what's happened is the market feels like it's trying to move on. It could be a bit of a head fake, and we then end up in a situation where the market reacts negatively again to the headlines. But in the backdrop of all of this, you've got to remember that we're still in a situation that the economic situation hasn't changed. Economic growth seems to perhaps be slowing, inflation is rising, central banks seem to be tightening. And so people are focusing back on that narrative with that war overlay, but they're still focused on that backdrop. So that could be what we're seeing now, where markets are now already moving on to the economic backdrop that has been the main focus of 2022. So it's been an interesting market this week, almost unbelievable, and sometimes you just can't explain everything that happens in the market and you just don't know why. But hopefully what I've done is shed some light into some of the things that are happening in markets and why they do, and also why it's been very interesting this week, because over the short term, are we seeing a bottom? Who knows? One last thing I want to point out before we move on is that periods of time like we've seen in the last few days when markets are moving very aggressively are great learning periods for people who want to run their own money, because you can see how markets behave and how their relationships behave. So when one goes up, the other goes down. And a good example, which I talked about on midweek markets, was Bitcoin and how that's been behaving. So there you go, a quick overview of what's been going on in markets at the moment this week, and hopefully some lessons there for people to learn.
Okay, interesting stuff. Thanks for that, Damien. We've got Harvey coming back on the show next, and she's going to be talking about sick pay insurance. So, Harvey, welcome back to the show.
Thank you for having me.
Okay, so Harvey wrote a piece this week about statutory sick pay and the changes that have occurred as a result of the living with COVID changes. But more importantly, what happened, we started to have a conversation in the office around sick pay, and more importantly, sick pay insurance. And some of the things that a lot of people didn't realise, one or two things I didn't even realise that Harvey was telling me about regarding how you can protect your income and those of your employees should they be unable to work through sickness. So Harvey, let me hand over to you. So the first thing, what was announced this week regarding statutory sick pay?
Hi, Damien. Yes. So Monday, the Prime Minister came to the House of Commons and made some announcements about changes to COVID restrictions and moved us into a phase that he's calling now living with COVID. And part of the announcement was around sick pay and how statutory sick pay will be paid for those people who may need to isolate due to COVID. And what had happened earlier on in the pandemic was that statutory sick pay had been moved from day 4 to day 1, so that if you had to isolate due to COVID, that you could claim statutory sick pay from the very first day that you'd had to be absent from work because of COVID. Now that's going to return to day 4 and fall in line with other reasons for sickness. So any other reason for sickness would mean that you have to wait until you're in your day 4 of sickness and absence from work. That does include non-working days as well. So at day 4, you can start claiming statutory sick pay.
So is that's the standard? That's what it was before the pandemic. So how long is it paid for?
It can be paid up for up to 28 weeks. So statutory sick pay will pay you for as long as you're off work and unable to work, and your doctor is certified that you're deemed unfit to work. You can self-certify for up to a week, but beyond that, you'd probably need some kind of medical certification to say that you were unable to do your job. When you're in that situation, then the payment continues. Your employer usually pays it through their PAYE as you would normally receive your pay, and any employer contribution may be paid in addition to that, depending on whether your employer provides that.
So how much is statutory sick pay?
Statutory sick pay is £96.35 per week.
Okay, and obviously that's not a lot for most people to be able to survive on £96.35, and obviously things are going back to how they were, where you're actually getting it after day 4. I mean, I think you did some bits on comparing that to the average weekly earnings, didn't you?
Yeah, I mean, what has happened this week is that the trade unions that have sort of pushed the government to improve statutory sick pay in this country for a very long time now, jumped on this and said, well, moving day 1 cover for statutory sick pay to day 4 wasn't a good move, that people still needed that security of having day 1 cover. But in the greater scheme of things, statutory sick pay is not very good, and it's amongst the lowest level of sick pay in Europe. Okay,
so those numbers that Harvey looked at in that article, the average weekly earnings, this is August 2021, was £581 a week. Now, if you do the maths, that's a shortfall of £484.65 a week, which when you work it out in a month, that's £2,100. And this got us talking about the idea of, like, is there anything you can do about trying to reduce that shortfall? And of course, this comes on to what we talk about as sick pay insurance. Now, there isn't actually a product that's called sick pay insurance. It's something that is called income protection insurance, which Harvey's going to go on and talk about before we then discuss some of the things that people probably didn't realise about it. And in particular, like we said at the start of the podcast, if you run a company, you really want to listen to this piece. So Harvey, sick pay insurance, give us a quick overview of how that works.
So sick pay insurance works so that it provides you with a replacement income. So if you're deemed unfit to do your job, you can't work, that it comes in and replaces not all, but most of your income. So you can cover up to about 60% of your income before tax. You'd still receive your statutory sick pay, so that £96.35 that the government pays, that would still be paid to you on top of what the insurance company paid to you. And you can get reasonably close to what you would earn after tax in a month through the income protection. But you choose, some people choose not to cover all of their income to the maximum value that they can, because perhaps their outgoings are less and all they want to do is really make sure that the bills are being paid and their essential costs are covered.
So one of the things that Harvey talks about a lot in the office, and it's a general feeling that people know what life insurance is and they talk about life insurance, but income protection is something that people should be talking about more, because you're much more likely to be off sick than you are to die statistically. So therefore, you're much more likely to claim on that policy. So people would go out and get advice, take a policy. They can dictate the terms, can't they? So it's their policy. They can dictate the terms of when the policy starts to pay out. Because interestingly, we were talking about it. What's the shortest time frame that you can take one of these insurance policies so it starts to pay you out a replacement income?
A week. So if you're off for more than a week, you would start being paid. So you choose your waiting time. In insurance terms, it's called a deferred period. And that period is the time for which you usually can manage. Most people choose a time frame that perhaps they could use their savings for, or their employer would continue to pay them their income for. And then the insurance kicks in after that. I mean, obviously, the longer that waiting period you choose, the cheaper your insurance policy will be for you. So the longer you can get by on your own resources, the better it is, because you really only want the insurance to kick in when it really needs to. But you can choose a period as low as 1 week. So you could be 1 week into not being able to work due to any kind of sickness or incapacity, and the insurance would start paying you a monthly income.
And it will pay you that income until you're able to return to work, or until the end of the agreed term of that policy, which can be as late as the date that you retire. So you can set that to be the retirement date, can't you?
Yeah, what you've just described, Damien, is a comprehensive sick pay insurance. So an income protection policy can be set up so that it covers you for the entire duration of your working life. So that means that if you never return to work and you reach retirement age, the policy could have carried on paying you up until that retirement age. But more and more now we see policies that provide budget options for people. So you may want to choose a policy that only covers you for 1, 2, or 5 years per claim. Doesn't mean that you can't make multiple claims, but for each claim that you make, you would only be able to claim for up to a year, 2 years or 5 years. And that can reduce the cost of a policy while still giving you a really good window of income, so that if you did suffer a serious illness, that at least you have some breathing space before you start seeing your income diminish.
And that's the thing that is worth driving home to people, that it's that multiple ability, the multiple claims that you can have on a policy over a period of time. And let's be honest, most people do want to return to work and will return to work within a relatively short space of time. So even if it was a 2-year policy, most people do return to work within that 2-year period anyway. So therefore it keeps the cost down. And one thing I was going to ask is, because we were talking about COVID, I know the answer to this only because you told me in the office, but I didn't appreciate that having issues regarding COVID are actually covered under these policies now.
They can be, yes. I mean, you should always speak to the advisors that are dealing with you, and you should consult the terms and conditions of your own policy. But I've yet to find a situation where COVID wouldn't be covered. Most insurance companies have really surprised people, because I think generally there's this consensus that insurance companies will try and get out of paying things. And during a pandemic, I think a lot of people were quite surprised that insurance companies continued to make payments for and continue to provide cover for COVID. So if you are off, and a lot of people have made claims for long COVID where they haven't been able to return to work for long periods of time, not just the sort of 5 or 10 day isolation period, and the policies have provided them with an income during that time.
And of course, that's the point, that living with COVID environment we are now in, there are going to be people who are physically living with COVID for a very long time, and these policies could help them, because you may struggle to go back to work. And Harvey's got an article, various articles on income protection. She's done a piece about this sick pay change. We'll link to it in the show notes. But another thing, people will be thinking, well, how much does this cost? It sounds expensive, but it's not, is it? You can get policies, roughly a premium a month. You could get it as low as £5, I think you were telling me.
Yeah, minimum premiums for this type of insurance start at £5 a month. The younger you are, the cheaper it's going to be. The younger you are, it's sensible to put this kind of insurance in place before you have any kind of health problems, because that factor that we were discussing about being able to make multiple claims really comes into its own if you do suffer a health problem, such as mental health problems, stress, anxiety, depression, and some musculoskeletal problems, because these are the kinds of conditions that cause the majority of claims for these types of policies, but also they're the kind of conditions that tend to repeat. So if you've had a bad back, you may recover from it and you might go back to work, but generally these things recur, and having policies in place from a young age means that they'll be covered, and they'll be covered on an ongoing basis. So once you've made a claim, you don't stop being able to claim for that same condition. You can continue to make a claim if it happens again to you in the future. So
that's another key thing, because these policies are medically underwritten, and there is a sense that some people think, well, then I'll never get paid out on one of these for something that's an existing condition in particular. And obviously I talk quite openly about my own Crohn's disease. Now, it's something I'm going to get excited on this piece, and you won't have heard anybody talk about this before in terms of what you can do if you run a company. Regarding obviously sick pay, if you're an employer like us, then the idea that people would only get statutory sick pay should bother you in some ways, because unless you're going to be able to pay for them long term, that's going to be a cost to your company that you're going to just do and have to probably employ somebody else maybe short term. But you can get group schemes of this stuff, can't you?
Absolutely. And very much like on an individual basis, it provides that peace of mind, that security, that notion that you could almost create a contingency for something that's quite unpredictable. Now, you employ a bunch of us, and if any one of us were to fall ill, then we may be ill for an unpredictable period of time, and you may need to employ other people to replace us, to fill duties and do work that wouldn't otherwise be done because that person's sick. Companies, small and large, can really, really benefit from having group income protection schemes, because what they do is they provide the security of an income for your employees. And even if you did have the resources to continue paying your employee, you could then move that money towards training somebody new, or even bringing in a temp, because you may want to re-employ that person once they're recovered.
And the other thing is that, of course, if you're a small company as well, there may be a realism that you wouldn't be able to pay somebody for long-term sick just out of the money in the business. So therefore, you'd have to have an uncomfortable conversation at some point when someone's at their low point that you wouldn't be able to pay them anymore. This stops that. Now, I don't mind talking about it on the podcast, but we actually implemented this for our company not so long ago. And one of the other big benefits is that if you are in a company, you run a company yourself, people who are in that same scheme can have differing benefits. You don't all have to have the same level of cover, so that can make it more affordable. And these schemes are affordable. But the other thing is, because the way they're implemented and underwritten as a group, it's not based on your individual health conditions. So for me, I would never get income protection to cover my Crohn's because I've had such a long-standing issue and still do regarding my Crohn's. But because it's part of a group scheme and you effectively are just a name and a number within that scheme, they don't care that I've got Crohn's. But if there was something now under our company's scheme that if I was off long-term sick because of Crohn's, something else happened and I couldn't work again, it would start to pay out and pay my income, which would alleviate a strain on the business. Now that is amazing, because you seriously could be, as a director of a business, you could end up, if there was a few of you and you had individual income protection policies, it could actually end up being cheaper to get out policies as a group that cover you for more than if you did it individually. Now that is something that I had never fully appreciated until Harvey spoke to me about it previously, and we looked into it. But that is quite amazing that you can do that.
It is. For a lot of people who already have health problems like you do, Damien, it is a bit difficult, because when you go to insurance as an afterthought to having suffered a medical condition, it can be difficult. I'm not saying that it's impossible to get insurances. You should always try if you are looking for them. But within a group scheme, what happens is the risk kind of is spread out amongst the healthy people and those people that may have some medical conditions. So you can get cover for everyone. And that's a real plus point and a real bonus. One of the other things that's a real bonus is that you can choose within that group scheme to continue to cover pension contributions for an individual whilst they're off ill. Now, as an employer, if you had somebody that wasn't able to work because they were ill, you may not make extra pension contributions for that person, but within an income protection group scheme, you can have that covered. So not only would you be able to continue to provide an income to your employee, but you could also ensure that that employee's pension is being contributed to whilst they're off sick, which is great.
I think that is another important point. So really, please, if you listen to this podcast and you may work for a small company, they may not realize that this is a possibility. But more importantly, if you run your own company, then this is a real benefit to not only your employees, but it is a real benefit to you as a director of a company as well. So it's a win-win situation, and the premiums are affordable. So what we'll do is we'll put a link in the show notes, which will point you through to how you can find out or get advice on this sort of stuff. The advice is free. You don't have to do anything. But if you want to explore it, then there'll be information there that you can actually go and do that. So again, we took the idea of sick pay, but when you start to explore this, there are things that you can do. And don't forget, this cost as a business is a cost to the business. So actually it can be offset in your accounts as well. So all of that is a real positive. So it was a great conversation we had this week. We started off with this sick pay change, but actually we meandered and came to sort of a full circle on it, didn't we? To the point that I think there's going to be a lot of learnings in there for people who could take away. And if somebody out there ends up benefiting from a scheme like this because of listening to a podcast like ours, then that can only be a good thing. And also will help Harvey, as it's her life's mission to get everybody protected.
Well, I think, we can't run away from the fact that if we're, as a country, talking about losing 3 days worth of sick pay at £96.35 a week, why are we not concerned about losing, on average, £581 a week? It's a really good question, and we all need to try and think about that question. And there's a solution, and we need to explore it.
That's fantastic. I couldn't have put it better. So that leads us on to the last part of the podcast with Andy. You're going to do the quick piece on insurance.
Yeah, so obviously the storms last week were fairly big news. We all know what happened, and they caused a large amount of damage, which left a lot of people scrabbling around, looking at their insurance documents and trying to work out what are they covered for. So we've written an article, Lauren did this on the site, and we've actually previously written a few articles about home insurance and what it covers. And I think it's worth just pointing out the kind of things you'll be covered for on your home insurance. Obviously, all home insurance providers work in a slightly different way. So you're probably going to end up needing to look at your documents and speak to someone, but this gives you a bit of guidance and a bit of an idea as to what is covered. So I suppose it's worth looking at what is technically defined as a storm. Insurers will tend to use a metric such as an actual targeted wind speed, and they often use the Beaufort scale as well, so it can be complex. And I'll give you an example, actually, David, to try and simplify it. Admiral Home Insurance classify a storm as a storm wind with gusts of at least 48 knots, which is 55 miles an hour, heavy rainfall at a rate of at least 25 millimeters per hour, and then if it includes other bad weather events such as snow, it needs to be snow at a depth of at least 30 centimetres in 24 hours, or hail that causes damage to hard surfaces and breaks glass. Now, as you can see, that's insurance terminology for it's going crazy out there, but it gives you an idea that it's not simple.
That sounded like the world was ending.
So that's the kind of classification you might see on a policy document. Obviously, you then want to know what you're covered for. And again, it's different depending on the insurers that you speak to. In most cases, you will be able to claim for damage to the building as long as you can prove that that damage was caused by the storm. And this is where it gets a bit grey. So you really want to dig through your pictures, see if you've got pictures of the external parts of the house prior to the storm and post the storm. And actually, in some specialist circumstances, the insurer may even send an independent sort of specialist out to your property to assess that damage, and they'll be able to make the call.
Can I make a confession?
Yeah.
I took pictures of the outside of my house before that storm hit.
Did you?
I did. I did.
This?
Anybody who knows me, I hate wind. I think this has come from a series of unfortunate storms across the southeast over years. When you own a home that's destroyed lots of things, it becomes such an unnecessary or unneeded headache that whenever it gets really windy, it kind of makes me a bit anxious that, oh, right, that's great now. This is a problem I don't need. And in fact, because I'd moved into a new house, I completely unaware of what would happen, and in my house there's particularly some parts that probably in time I will need to improve in terms of the roof, and I'm just thinking, if this is the worst storm in decades, am I going to have any of this left? And equally, I did take pictures of the outside of parts of the roof and bits of it, because I also wanted to see what did they look like after the event and before it, if I thought there was something that had happened, because I wouldn't know that has something blown off the roof, because I've only lived there for a very short period of time and I've never looked at the roof before or outside parts of the house in any particular detail.
Do you know what? That's a pretty good tip in itself. You know, if we get some warnings of bad weather coming in the future, that's probably a really good tip. Have a look at the outside of your house, take some photos, and then you've got something to compare it to. So I think that's brilliant. In terms of covering your property inside your house, home insurance is often split into two parts. You've got home insurance, or what they call buildings insurance, which is generally the external parts of your property. And then you've got something called contents insurance, and you can buy them separately or both together or combine them together. The contents part of the insurance will generally cover you for any damage that's caused to the inside of the property due to a storm, such as flooding and things like that. Again, it will depend on the policy, but you can claim on post-storm events. Maybe if there was a breakage of glass and the winds gusted in and it broke furniture and contents inside, that would generally be covered. And so going on to the home insurance in general then, in terms of what you can and what you can't claim for, I thought it was probably a good time just to list off a whole heap of things that generally you will be able to claim for, and then a list of things that you won't. In terms of storms and what you can't generally claim for, you're going to be looking at things like fences and gate posts and things that are kind of on your boundary of your property. Those are things that you'll probably have to foot the cost yourself. Again, it's worth checking your documents, but the general rule of thumb is that isn't covered. So try and secure those things down before bad weather hits. And so to finish off this piece then, let's just look on a broader sense of what is covered on home insurance, because it makes sense to understand what that cover is and how it works. So we're talking about big events, things like damage caused by fire, smoke, vandalism, frozen or burst pipes, storms we've covered, explosions, flooding, leaks, subsidence, and actually damage caused to your property by collisions, which seems like a weird one, but it actually happened to me in my village. There was a car smashed straight through the front window of a poor person, and obviously that's covered by insurance. And in terms of contents insurance, that all of that is covered, and obviously things like theft. So obviously there's a lot of stuff there covered on your home insurance. Things that aren't covered are things like maintenance and problems with your house that happen along the way. And I'll give you an example. Damage to your property caused by pests such as birds or rodents, damage caused by leaky roofs and gutters, any legal expenses that are incurred, mechanical or electrical failures of possessions, including things like fridges, and finally, any accidental damage to possessions on the contents insurance. But some insurers will charge extra and add it on as an optional extra.
Yeah, and I mean, that's a broad list that Andy's done there, which gives people an idea of how these policies work. Yeah, as Andy said at the start of the piece, make sure you check your own policy details because they're all very different. I've told this story once before on the podcast, but I'm going to say it very quickly again because it happened years ago and you may not have listened to the podcast. But it is interesting about what happens when somebody else damages your property. So I had an issue many years ago. A neighbour put out a bonfire, didn't put it out properly actually. 5 hours later, it caught fire again or reignited in the middle of the night. It caught all the fences in the local terraced houses where I lived on fire, destroyed a lot of things. And the problem we had was when we were trying to claim, obviously against him on his insurance, the way the insurance process works is that I had to claim on my own insurance and then my insurance company would claim back off of his insurance for the money that they paid out to repair the damage to my property. But what it meant is that I could only claim for the things that were covered under my policy. So there were actually things that were damaged. So it was in terms of to external buildings that were not covered under my policy. So certain damage to certain things like patios and things like that I would have had to taken the person to court to try and get some money out of them. This is despite the person completely owning up to what happened, held their hands up, gave all the insurance details. It should have been simple, but through no fault of my own, I wasn't able to get everything repaired to how I wanted it to be because my insurance company wouldn't pay for it on my insurance because it wouldn't have been covered had I made the damage myself, and therefore they wouldn't claim beyond the policy remit from the other insurer. Everything else was claimed for and went through okay, but there were some bits and pieces that I couldn't actually get repaired and had to pay for myself because it wasn't actually worth going through a small claims court for them. So that just shows you that it isn't as straightforward with home insurance and contents insurance as everybody thinks it should be. So that's it for this week, Andy. We are done. As ever, please review the podcast. We always say it at the end. We should say it at the beginning. And one thing we've noticed that soon it's going to be our 500th show of this podcast, isn't it? Combining Damien's Midweek Markets with the number of shows we've done on the Sunday podcast, which is something to celebrate. So please do leave us a review if you haven't done so already. If you have done so, you can still leave a second review. In fact, iTunes and various different sites don't stop you leaving multiple reviews after a period of time. So do leave reviews, and it really motivates us and the team. And for us doing 500 shows, I think it's worth a minute of your time to leave us something nice.
Should we produce a new mug on that?
Have
I just put you on the spot?
We probably have, and I think we should produce a 500th mug. Maybe we will do, and people who leave a review, maybe we will do. Okay, so until next time.
Until next time.